Welcome to the Broken Pie Chart Podcast, episode 389. I'm your host, Derek Moore. Once again with me, Mike Snyder and Shane Skinner. All right, let's do this right up front. So SpaceX. I don't know if anybody's aware in the audience, but SpaceX, they're having some shares become unlocked. So they had their first earnings call. Earnings happen August 6th, the shares unlock, and they might be sold over, people might sell, they might not sell. I'm sure some people will sell, but it's unlocked. And a lot of people think, well, sure, once the unlock happens, it's going to go down because there's more sellers than buyers. It's going to push things down. And that very well may be the case. Historically, we've seen that. We've seen as things come unlock. And I think they said about 9% more of the stock might have a free float. There's an interesting thing here, though, in that it's already in the index. And the way the NASDAQ 100 weighting, it's based on an adjusted market cap. So not simply the market cap. And for companies with limited float, and I think the NASDAQ basically did this for SpaceX, it's the total cap times the minimum of 1 or 3 times the float percentage. So if there's a 5% of the stock is considered free floating, meaning it's not closely held, it's a 15% effective market cap. If it's 10% free float, it goes to 30. If it's 12, it goes to 36, and then 33 and a third or higher, it goes to 100%. So, assuming the market cap right now, I think, what was the free float? Like 5%, 5% of 1.5 trillion, back of the envelope. I think it's 1.7 now after today, 225 billion. So the effective weighting, I think we're somewhere between, just south of 1.5% in the NASDAQ 100. And it's, when I say about, I didn't look at it today. Other stocks are changing. Stocks are going up, going down. SpaceX is going up or going down. And so by my calculations, if all of today's or the unlocked shares from the other day that are now unlocked become part of the free float would increase from, it would probably go from about 5 to 10 to 12%. So basically, you would go from a weight of 15% to roughly 35%. I don't know if that's going to happen. I don't know if necessarily all these shares, even though they're eligible from reports, like I'm not really watching this. I'm just kind of reading things on Bloomberg and CNBC and other things. So if you went from, I don't know, about a 1.3, 1.5% weighting in the NASDAQ 100. I think if you go to over a 3% weighting, it may actually put it into the top 10. And depending upon what the market value is. Now, look, I'm not telling you should buy SpaceX. I'm not telling you should not buy it. Like, you do what you want to do. Full disclosure, I actually have a tiny little position. And just because I have that, literally, it's tiny. Just to kind of, I don't know, I was sort of interested in participating. It might go up or might go down. I don't look at this as anything else than what it is. So you got to figure out if you want to own it. I just think it's one of those cases where if you look on Twitter or you look online, and there's all these stories about how wait for the unlock. It's like, well, wait a second. It's in some of the big indexes. It's in the NASDAQ 100. It's in other indexes. It's not in the S&P yet. And in theory, the indexes have to buy stock. Now, that's just one aspect of it. The company could be garbage and it could go down. It could report bad news and it can go down. You could have more sellers than buyers, irregardless of the people that are unlocking. And this is just one factor. So I just found that interesting. And I remember when Warren Buffett's 13F hit. This is going back, it might have been a year ago. So the 13F hits, and it turns out he sold a lot of Apple. And people said, well, this isn't good for Apple. Actually, I remember reading news reports and some stories that the S&P and some of the other indexes because it opened up more of the free float. They actually had to buy stock when he was selling. So the public service announcement on this is you don't really know what's going to happen with these shares, but just because it unlocks doesn't necessarily mean there aren't other buyers. And I think this is one of the reasons why Elon was really pushing for it to be in the indexes. Now, I'll throw something else out there. The NASDAQ, from memory, they do a quarterly rebalance. And they have it's a pretty predictable schedule of when they do this. And I believe the September rebalance is based upon the last trading day of August. So in other words, if the free float goes up, and this is my understanding of it, I mean, they could do other stuff. And remember, this is just all else equal, and it never is. I believe they do the last trading day of August as sort of the marker of the free float, and then other things that need to be adjusted. And then I think after is it 2 weeks into September? I think it's 2 weeks into September, and maybe it's the second Friday, however they word it. They'll announce a rebalance. And then usually 3 weeks into September, they would actually do some rebalancing trading on there. So I thought I'd start out with that. It's a little bit of public service announcements, a little bit of education there. I'll start with you, Mike. So, I mean, this is kind of unique that you have a stock this big that IPO'd. You have the float. It's almost kind of cool for people to learn about some of the market mechanics here.
Yeah, absolutely. And like you said, it doesn't mean that the stock's not going to go down, but it is another, part of the market where, a lot of talk is about the unlocked shares and, sort of an assumption that there's going to be a significant amount of sellers, which there very well might be, but haven't seen a whole lot of talk about what the indexes are forced to do. And like you said, that's going to happen, I believe, at the end of the month. So it doesn't necessarily mean that as these shares are being sold, the indexes are buying it now. But it is an interesting, this is a very unique situation. Like you said, I don't know that we've seen a company this big IPO with this low of float.
And be in the index right away.
Right.
I mean, this is kind of, yeah. Did you listen to the earnings call or hear any bits of it?
I heard bits of it.
Okay. What'd you think? And you're not you're not doing your analyst thing. You're not, saying it's good or bad, just general thoughts on it.
Yeah. I mean, I can see why so many people believe in it the way that they do. I keep going back to the sort of the addressable market, especially if they open up Starlink to sort of retail and take a big part of that market. I mean, there's big potential. Now, whether that actually plays out, that's the operational part of this, and that's the risk. But there seems to be significant potential if they operate correctly.
I mean, the bear case on this, you take somebody like Professor Aswath Damodaran, who, to your point about TAM, total addressable market, thinks it is crazy to say like, oh, it could be 20 trillion addressable market when the whole S&P is what, like, I don't know, is it 60 trillion? I'd have to look at that. I get, and then there's Tom Lee. Like Tom Lee, Shane went on, I think it was CNBC, might have been some other outlet, where he's just like, look, what people are missing about this company is it is, in his words, a conglomerate. Like they want to go into consumer cellular through Starlink. They're doing enterprise Starlink. And Starlink's the thing that's actually cash flow positive. And then on the earnings call, they're talking about like renting out compute space and data centers. You have space. Like, I mean, we'll know when we know which of these viewpoints is right. Shane, don't you think though that, and I think Tom Lee made this point, a lot of people looked at Tesla as just a car company. By the way, Tesla sold off a lot after their IPO. I mean, this is really topical and it's kind of exciting to see, regardless of where the price goes. Do they have a limited window though, Shane? Because Anthropic is going to come on deck soon.
So I was actually just wondering that, and terms of just the broader market and what's going on. And yeah, there's more IPOs looming, and this is just almost kind of felt like the guinea pig initially for what could be a round of very large IPOs. And so seeing it go, I would consider it's gone smoothly. The market's done fairly well since it IPO'd, and it's sort of sold off a little bit from its IPO price, but there was a nice bounce today, right on, the unlock. Sort of did the Costanza, did the opposite of what I think a lot of people thought it would, and that more shares became available and it ran higher. And I think I'll allude back to what you were saying about, maybe the index had to do some purchasing because of it with more shares coming out. We'll see what happens in terms of the actual company, though, and what's to come. I'm really interested in seeing how their like data centers, chips, Grok comes into play, that type of stuff. I think it's very clear with the satellites, the internet, the US cellular stuff. I think you could see a conglomerate there. And I think that, the Tesla thing, like, yes, it is definitely a car company, but they have so much data, and the work they've been doing in the automation space sort of, I think, naturally, organically aligns with what's going on with this company here. And again, I allude back to what I've said prior. I think eventually those companies combine. Maybe they don't. Maybe it happens in 20 years. But there's a lot of synergies between Tesla and SpaceX. So I'm excited to see how that develops.
Somebody reminded me, isn't Twitter part of under the SpaceX umbrella now?
I think so.
Didn't Grok AI merge with it? Like that's
or X.
Totally forgot about that. Yeah. So, all right, look, we'll see what happens. I think to my point about the runway, like once Anthropic's S1 drops, and then that's the next hot IPO, and then that's going to take a lot of the air in the conversation. Right now, it's certainly. So I did listen to I like listening to the Q&As, the initial part of a call. I signed into it. I think I must have signed in through the institution, which, I mean, we are a professional, registered investment advisor and all that. But we're not analysts. I mean, we don't function as analysts. But the link, I don't know how I found it, but the link I had, I think I could have asked questions. I doubt they were going to take my questions over the Goldman Sachs analyst and, those people. I've told this story before, but years ago, I was trading, it was a very, very small stock. I think it was Elon. So this must have been like, late 90s, early 2000s. And you used to be able to dial into a company's conference call and you listen in. So you literally dialed in on the phone. There was no web or anything. So I dialed in and they asked me, the firm I work at. And I told them the firm I worked at, and they put me into the analyst line. And all of a sudden, the operator comes on. Now we have Derek Moore from so-and-so. Go ahead with your question. And so I asked a question, and somebody else I knew he comes running out of his office. He's like, "What are you doing? You can't ask questions." I thought I was going to get fired. So but I did ask a question. It was a very small stock. There were like 5 analyst questions, and I was one of them that day. So I asked my question.
That's awesome.
Yeah, I was worried at the time, though.
If you could have asked a question for SpaceX, not to put you on the spot, what would it be?
I mean, how many years do you not necessarily care about making the maximum profit? Like and I think some of the analysts, though, they were trying to get him to get to an answer, but it's like, hey, you have this compute capability, you're building data centers. What percent are you, and people asked him this, what percent are you going to be able to rent out? That's what they were trying to get Zuckerberg to, they were asking him about renting it out. So I don't know, what would you have asked him, Mike?
No, I think something similar. I heard I'm trying to get to the bottom of that and wasn't really going anywhere.
I mean, the consumer cellular to me is, and I forget what her name is. She's I believe the CFO or the CCO. She talked about the big three have revenues of $600 billion. So you're talking about T-Mobile, Verizon, AT&T. And I think she kind of touched on that. Like, what if you had Starlink as your cell provider and then there were no dead spots and there's all this revenue? So, yeah, I don't know. I forget what my question was, but after I asked it, I'm like, oh boy, like I'm probably not supposed to, as a 20-something-year-old at a big brokerage firm, supposed to be saying my name and from that brokerage firm. And anyway, I'll tell you off air who the firm was. All right. Let's talk about the labor force, employment rates, and what this means for interest rate. The market really liked the fact that there weren't as many jobs created. In fact, I think there was a slight miss. Daniel Lacalle on Twitter, and he put something out. He said the Fed is already negatively impacting the U.S. labor market. So he's been critical of the Fed, said, look, you should be cutting rates, and rate hikes are not justified. Private payrolls rose by just 30,000. Manufacturing added 5,000. Participation increased to 61.4%, and unemployment fell to 4.1%. And the participation rate has actually been going down, and it was lower than expected. And it was negative 23,000 change in non-farm payrolls. The survey said 80,000 was the expected. So his point, and Charlie Bolello on Twitter also put out a chart showing the labor force participation rate, the lowest since 2021. So remember how they measure unemployment. If you are working, then you're employed and you're in the labor force. If you are not working and they call you like, hey, are you working? No. Okay, cool. No, actually, I don't mean cool. Like, thanks. Are you looking for work? Have you looked for work within the last couple of weeks? Yeah, I'm looking. I'm trying. Okay, that person's still in the labor force, but they're unemployed. If you are not looking and you're not employed, then you're not in the labor force. So you can have people come out of the labor force and jobs don't necessarily go up, but the math works out that the unemployed is now different. So if the unemployed people are like, yeah, I'm giving up, or I'm not looking, I'm going to go be a poet or sail a boat across the world, whatever it is. Although I guess if you weren't working, probably not a good decision to spend money and sail across the world. I don't know how much that is. I mean, to Daniel Lacalle's point, like, this is not really showing an overheating economy. And I always say this to people. I say this to people who are demanding rate cuts. Be careful what you wish for. Like, if they're cutting rates because the economy is not doing well, or there's some exogenous event in the markets, like, be careful what you wish for. Those that are on you should be raising rates. To Daniel's point, like, I look at a lot of this stuff and say, would any rate increase help the price of oil? Set that aside. I mean, would raising rates really help here? But I thought it was interesting from those two viewpoints. JC Peretz put out a graph on the US dollar. I know a lot of us watch the US dollar. And the US dollar was sort of breaking out on a technical basis, came up against some upside resistance, and is now back below. The audience can't see this. But the dollar is sort of a reflection of the relativeness of US interest rates against other currencies in a big part. So the dollar is saying a rate hike's off the table. So, I mean, Shane, when I look at this, I know you watch the dollar as well. Like, the dollar is sort of telling you, yeah, they're not raising.
No. And I think that, I think our choice to help with the yen situation was a clear signal that we do not want to see a sell-off of treasuries right now at this time, with rates where they are and the debt and the burden of the interest of the debt that's going to be coming due soon. I mean, I think you've written about this in your book, actually. Like,
thank you. Broken pie chart available on Amazon. Yeah, get it now. Sure. Thanks. Thanks.
Yeah. But you talked about how, like, look, bonds are, like, government debt's not going to necessarily get better. And so I'm with you in the sense that if they're lowering rates, it's likely going to be because something's breaking. I also think that if the rates don't come back down, I don't know how much longer the government will be able to finance its debt at these rates. And I don't want to get down this hole too deep, but at the end of the day, higher rates, while it sounds like, oh yeah, let's do it if we can, it's more than just oil that's at effect there too. And I think that people need to consider that as well. Maybe the tariff thing eases that. I don't know, but governments finance its debt at some point, and you can't do it.
I don't disagree with you, Shane, but I would tell you I was concerned about this stuff in the 80s, and it never mattered. And this is another one of those that will matter when it matters.
Right.
People aren't wrong who look at the debt and the fact that the net interest payments are greater than what we spend on defense now. And that is crazy to think about. But it hasn't mattered. And, and
it might not. Right. And it might not. And if rates get lowered and this gets refinanced, don't you think that there's the potential that they'll do what's always sort of been done, and that's sort of gets inflated away and we move on to the next sort of cycle or phase?
Well, it does. But remember that the U.S. is not in a vacuum. Like, it's a relative game. And it's not like Europe is 10% debt to GDP. Like, right. They're spending money in there, and all of the countries are really doing this. So on a relative basis, you're thinking about what the currency is going to be worth. The other part of this too is it assumes that you need to pay that back at some point. Like, I'm actually with you, Shane, but I'm just taking the other side because I think about, for an investor, if someone said in the 80s, like, oh, I better not, I better put my money underneath the mattress, they would have missed out on massive amounts of gains and their purchasing power would have went down. And that's all I'm saying,
Right. Yeah. So you'd make the argument then at that point, it might not be cash that's the best answer in an environment like that. It's assets. It doesn't necessarily mean there's who knows which asset's going to do the best. But
well, I would also say that when people talk about the dollar losing all its value, that's assuming you stick it under the mattress. Like, if you would have bought Treasury bills over the years, you were getting some return similar to inflation. It might go up or down, above or below. But if you had done that, your purchasing power would be, I'm not saying one for one, it would still be the same purchasing power because inflation could run more than the interest rate that you got. But Mike, I guess the other part of this too is, if I look at the probabilities for a rate hike, the September meeting and now the October meeting, based upon the probabilities, it's only a 43% chance. In September, it is let me see.
It dropped quite a bit with jobs, didn't it, this morning?
Yeah, I think that's right. On the fly, I could try and let me just look at my Bloomberg and see if I'm able to do that on the fly. But Mike, the market loved that. It's like, hey, we lost 23,000 jobs. Awesome. That means they're not going to raise rates. Like, the market loves this.
Yeah, it's a bad news. Good news.
Yeah, there you
environment. Go. Yeah, I think it went from like a 60% probability down to, like you said, a 40% probability in September for a hike. So that's why we saw the market rally. Lower odds of a hike, and the market likes lower rates at the moment. Last meeting, Warsh said the market was sort of acting for us in having higher rates. And so I don't know that they were even necessarily committed to raising rates, but certainly the probability going down is helpful.
Mike, don't you think though that I kind of lost my train of thought, but like, does this even matter? Like, who cares if they raise rates by 0.25%? Who cares? If they cut by a quarter, we're sort of in this range now where rates are not high. Okay, for anyone who thinks rate 3.75 target rate is high or effective rate of 3.63 is high, you're crazy. Let me show you the 80s or the 70s. or the 90s. Like, this is not high.
Yeah, I think long term the market has shown ability to absorb interest rate hikes and have the economy and the market still grow during those periods. Short term, sometimes there's more volatility and sell-offs and some shock if there's an unexpected hike or a hike that the market short term doesn't like. But over history, we've seen the market go up during hikes. So does it matter long term? Not as much as earnings. I mean, if earnings keep growing and interest rates go up, the market follows earnings. So short term, I think if you want to know what the market's going to do in the next 2 months, which is a really difficult thing to figure out, interest rates could affect that.
When I look at the markets though right now, I think it's smart to point out earnings. Like this, the economy is not the market and the market is not the economy. And when you look at earnings, you look at earnings estimates being raised. You look at net profit margins being raised by analysts, the expectations, the analyst projections. You look at sales going up. And sales is sort of the thing that, you can jerry-rig that, I guess, but it's not the same as earnings per share where you have an accounting change or you have, something. And sure, you could do like Enron was booking future sales on a factory that wasn't even built yet 10 years in the future. So I get it. But sales is, you grow that top line, things get a lot easier. And these companies right now are, the question is, are we in the 4th inning or the 7th inning of this AI build out? And when you listen to the earnings calls, unless they're wrong, it feels like they're still going to need more and more and more compute. We'll see. All right. Where are we in the time here? Okay. So I want to go back to the cost of shipping a little bit. And I haven't talked about this in a while. Container rates, and I know both you, Mike, and Shane, daily you're checking FreightWaves, which is the industry site for shipping news and logistics. I know you've got that bookmarked. And of course, you're always looking at the WCI composite container freight benchmark rate per 40-foot box jewelry. On a container ship, that's like the boxes that get put in there. It has turned down recently, although it went up. The chart here says, 4297, 4,297. Put that in perspective, it was over 10,000 in September of 2021. Recently, at the end of 25, it had crested below 2,000, so it's higher than it's been. But I hadn't heard of this. Eric Baltunas put out a tweet today. Eric Baltunas from Bloomberg, he's kind of the ETF corner guy. He says BWET, that's a symbol. We'll get to what the heck that is. That's oil shipping futures in Middle East, in parentheses. The best performing ETF again for the past month. Year-to-date returns are now 1,294%. Wow. Insane. 5x more than any other ETF, and yet still no one cares. It's odd. The degens are out there in full too. Sometimes fishing is like this. You can literally see the fish in the water and they just swim right past your bait. Just not feeling it. Maybe it's just a tad too obscure or because it isn't leveraged. Not sure. Interesting though. Quote, end quote from Eric Baltunas. I did look and I said, what the heck is this thing? So if I pull up, what is that symbol? BWET. Mikey, heard of this yet? Is this on your radar?
Shane told us about this.
Oh, you probably did, didn't you?
I tell you guys about too many things, and so it's unfortunately when you give too much, it gets lost in the mix. I'd forgotten about this thing. I think I brought it up in April, and here we are 4 months later, and it's still chugging along. This is crazy.
It is. You sent us the timestamp 4/9 of 26. So this is like the people who cold called in the 90s. You're like, look, Mr. Moore, I gave you on April 9th BWT It's up since then. Here's what I'm working on now. That's how that would have gone, you know?
Great.
This is the Shane, this is the Breakwave Tanker Shipping ETF. It's an exchange-traded fund designed to reflect the daily price movements of indices that track the future cost of transporting crude oil. Okay, not surprising given the goings-on. BWET offers investors unlevered exposure to oil tanker futures. I'm not really familiar with the oil tanker future market. I'll look into that without the need for a futures account. So it's buying derivatives. So when did you give this to? April 9th? Let me look at the return since April 9th. This will be interesting. Yep. So April 9th. And that was this year, right? It wasn't last year?
Correct.
All right. So April 9th, you gave this to us since April 9th. Oh, it's only up 68.97. It's not like I missed out on that much, right?
No, you could have got that anywhere else. Easy. Jeez.
So,
but that was the top, by the way. When I sent you that, it was trading at its peak. So it did have a little bit of pullback there, it looks like. I wanted to mention real quick, it only traded less than 250,000 shares today. So it's not like this thing trades a ton of volume. Like you mentioned in the article, no one seems to really care. I don't know. It's weird.
a little over 40 million in market cap. And I'm looking at the creates and the redeems. So in ETF speak, as more money comes into an issue, they create more shares. And if money comes out of an issue, they redeem those shares. So the share counts. And yeah, and actually the outflows have been, it may have gotten some inflows of late, but okay. Eric Baltunas always finds some random nugget though. Like he's on top of the ETF world and he puts out some great content. He wrote a book on, I think it was I haven't read it yet. I have it on my list about Vanguard and ETFs and things like that. But all right. Yeah, random, right?
Pretty amazing that you can buy exposure like this via an ETF now. I think this goes back to like the argument ETFs are still potentially early on in the game. Well, I don't know how you would get exposure to this otherwise without trading those futures, which again, I don't even know how you get access to those.
Yeah, I'm looking at the 13. So, like we have to file our 13F, companies file 13Fs. It tells you what you're holding at the end of the quarter. I'm trying to see who's holding this. Jane Street's the biggest holder right now. Jane Street's a market maker though, so maybe that's just on their books or maybe they're the lead market maker. I don't know. Okay. What I mean, I remember showing Jay like there was a cocoa futures ETN back in the day.
Yeah. Yeah, I remember that one
just some random stuff here. So not surprising though. Like the cost to ship oil in the Middle East is probably right time, right market if you own this, I guess. His point though was like, so when he says the degens, that's like the Wall Street bets crowd. The people who are just going into Hertz when it's bankrupt and like this would have been an interesting one for them to go in. Mike, are you doing an order right now in the aftermarket for this?
I'm actually just looking at the options on it. There are options. Huh? Yeah, I didn't think there would be, but yeah, they're pricey as you would imagine.
Like what's the vol on? Give me the at the money vol like a month out.
Yeah, it's it's trading at 287, the 285, 97% implied vol.
97, right? Okay. That's pretty sporty. I'm looking at what they're holding. Please don't anybody buy this because we brought it up on the show. Or don't sell it. I don't know. Do what you want. So they own Middle East Gulf to China futures, and then West Africa to continent US or to continent US dollars. Okay. I'm not familiar with these contracts. I will look into it over the weekend. So, all right. I mean, I think I think we've beaten that horse. I'm going to do it. I wasn't going to do it. I'm going to do it. You know, I take responsibility for getting strategies the way they were measuring their 30-day sharp. Why they're doing a 30-day sharp, I don't know, on their STRC preferred holding. So do you guys remember they had that obscure, like, they looked at the total, the yield to maturity, and they had some different one. So they changed it, and now they have a 30-day sharp. I should have put this in the doc for you guys, but I will put it in our chat so you can see it. And maybe they're using some different measures. It is really funny, though, by the way, Shane. You gave us that symbol a while ago. All right, coming over. So what I did was I tried to look at this, and I pulled the prices from Bloomberg for a 30-day period. And they have now on their site the 30-day sharp, at least when I did this is like last weekend, 0.53. And they say it is calculated by annualizing the average of the last 30 trading days, daily excess returns, daily return minus daily risk-free rate, divided by their standard deviation. So I don't think you should do the average. I'd have to look at the official, CFA definition. But anyway, whatever. I took this. This is just for sport. Like, I really don't care about this, but I'm just like, I didn't know why they were showing the sharp the way that it is. At least they're doing it differently now. So the way I calculated, I came up with 0.0104 for the sharp ratio. And I had the standard deviation annualized, I had the annualized return, and the annualized excess return, and the annualized risk-free rate. And then, of course, to get the daily, you convert it to a daily risk-free rate. I don't know. I mean, I pulled the prices from Bloomberg, and then I did it differently. I said, let me just use the average daily excess return, which is different. And I did the daily standard deviation of the excess return. I'm going to bore the whole audience here. Doing it based upon that methodology, I only came up with 0.26. The explanation could be they may be pulling prices from somewhere else, or maybe I just didn't calculate it right. But this is kind of sport for me at this point to look at Strategy's website and see how the heck they're doing this. And why they would do a 30-day sharp ratio, I have no idea. Like, that doesn't even make sense to me. But I'm going to leave it there. Mike, any thoughts here?
I think you covered it.
Okay. All right. It's probably better I wish I would have taken a screenshot of, remember that other way they were doing that, Shane? Wasn't it like...
Yeah. No, it was different. It flipped.
Wasn't it like the yield to maturity over the risk-free rate or something like that?
Yeah. And then, I kudos to you for trying to reverse engineer this, because if you can finally get to that number that they're getting, I would love to see how. Like, I applaud you at even attempting this.
You really shouldn't. This is wasted effort for me. I mean, it didn't take that long because once you have the prices, it's just, but I don't think they're supposed to take the average. I think you're supposed to take each day and then, it's like the daily excess return, the daily return minus the daily risk-free rate. You do a standard deviation. Anyway, I don't know. Are we done with this? Can we move on?
Please.
Okay. So I guess the other thing too is, do you think we're at a point now, and I'll go to you, Mike, first. We're at this point in the market where people are feeling like they missed out and they have to buy. Like, it was kind of curious how we had a little bit of a technical pattern. Wasn't exactly a full pennant, wasn't exactly a triangle, but you had price kind of oscillating between these two ranges, and the lows got higher and the highs got lower, and then you kind of squeeze out and you break out to the upside here. We'll see where it goes from here. Mike, do you think this is kind of a reflection of some of the bears have just thrown their hands up and been like, maybe I just have to participate?
Yeah, I think so. I mean, we just had, a couple weeks of pretty large companies reporting very solid earnings, mostly beats and strong forecasts. And, I think there was a narrative going into those earnings, as there seems to have been for the past few quarters, that the market's priced to perfection, and that all these companies have to report perfectly, and thinking that there maybe is going to be a misstep or that the AI trade is overheated. But earnings have been strong, and I think that was the most important thing. It's sort of clear. It's sort of cleared the deck a bit for some bears to look at this market and say, I'm going to really underperform if I don't do something here, because these companies are not only reporting strong earnings but projecting well too.
When earnings estimates have gone up, we always look at this every Monday, and Shane, we looked at it. I mean, earnings per share, 28.04% forecasted growth over the next 12 months. Earnings per share before extraordinary items like that. Google had a stake in SpaceX and they got to realize that, or almost 30 and a half. The forward 12-month forward PE, 20.59. Like the E is growing greater than price is growing. And so you're seeing the forward valuation come down. I don't know, it just like, why now? Like, why all of a sudden do we see that surge of buying last week, Shane? And that's, I always kind of think about like, why did that happen? And then I think maybe people are just capitulating, like the bears are capitulating, and maybe that's a near-term top. I don't know.
Yeah. No, I think you could be right about that. I mean, I think that, another phenomena that we've started witnessing, I think, is this relationship between hedging going on and shorter dated options. Like the market's more efficient now because there's more options listings, more expiration dates. In some names, you can basically hedge within a day or on the day of expiration for earnings. And so as more products become more available, more ways to hedge, more ways to maybe sort of get in front of stuff without having to actually sell shares outright, I think that it's not crazy that we see going into earnings season, likely some insurance is getting purchased that might have a little bit of a drawdown or a sideways effect on the market. And then as we get into the earnings season, things go well or how the market sort of wanted them to, we should say. And the effect of unwinding those hedges tends to lift the market. And so I don't think war spooked the market. I don't think the earnings spooked the market. And the old saying, I think, is like never short a dull market. Obviously, sideways markets can eventually turn down too. But, something runs sideways long enough, it's going to eventually make a decision. And this earnings season, so far, it's seemed to go higher.
Mike, yields haven't really, they were raised, they were rising. Maybe it's some of the interventions Shane mentioned with Japan. But I don't think a 4.6 handle on the 10-year is the worst thing in the world, Mike.
No, I don't think so either. Like you said, rates are not historically high right now. I don't think that, 4.6 is going to do anything to the market with the earnings that just came out.
All right. So
can I say one thing about the labor number?
Yeah,
today?
Talk about it.
So like the labor force participation rate chart that you sent here, I know we talked a little bit. It looks like this was from Charlie Bolello, right? We're the lowest since February of 2021, 61.4%, and the U.S. labor force participation rate. I'm just really interested to see how this is going to develop over not just, the coming months, but the coming years and decade, as AI is expected to continue to replace jobs and or have an impact on the labor force. The Fed's mandate's always been maximum employment, right? If possible, while keeping a lid on inflation. That's sort of that dual mandate. Isn't it almost like a natural deviating away from that by the market itself if AI is going to start doing that more and we're going to see less participation rate due to AI replacing work?
Well, I'll play the contrarian here. when Excel came out, were there more or less jobs? When, email came out,
The internet,
were there more and less jobs?
Right.
The internet, more or less jobs.
Technology, yeah, it's a tool almost more than it is just a pure replacer.
I don't buy that it's going to replace. It may replace some functions, and people may, but like cobblers in the late 1800s. I mean, you don't need cobblers anymore because you have automobiles. A cobbler, I believe, is the right term for putting the shoe horses on shoes. I believe, right? I probably am getting this wrong. I have no idea.
Maybe that was a shoemaker, but I get your point though. Yeah.
Well, we'd still need a shoemaker. I don't know. I'll have to look that up. I mean, it's sure. You could say that. I mean, there are people out there who think that all the jobs are going away and the robots are going to take over and self-driving cars. What are you going to do with the truck drivers and all this stuff? I mean, in the end, supply and demand, long-term in the economy, sort of people go to where there's new industries that didn't exist before.
Right.
So I don't think it's as dire as people think. And the question is, in sort of the shifting there. So I don't know. It's something to watch. All right. Can I play something for you guys? We're going to do a public service announcement here. So give me a second. I'll play this and then I'll tell you what the heck it is.
People don't trust the creditworthiness of the United States over 30 years. And so as Treasuries spike, I could now buy a U.S. government bond that pays me 10% pre-tax a year. Why the heck would I pay 50 times the earnings for semiconductor stock? So that creates the incentive for markets to move against.
Okay, so that was from the All In podcast. Are you guys familiar with this one?
No.
It's Chamath Papatia, David Sachs, Freeberg, and I think that was Freeberg talking. And why can't I remember the other gentleman's name? It's like number one or top couple podcasts in the world.
Jason Calacanis.
Yes. And they're all like tech entrepreneurs. And, Chamath should be familiar to the investment world because he was involved with the SPACs, but he's been involved in private equity and others. He used to be on CNBC all the time. And I had a wealth client send me that. And he's like, why don't we just buy government bonds 10% pre-tax? Did you catch that there? So
yeah, I heard
here's
that.
Here's a public service announcement.
The 10% pre-tax. Yeah, I heard that too.
I'm surprised because Chamath is on there. And I think Chamath, maybe he just was, getting ready for his segment or something. I would have expected him to kind of come in there and correct that. So it sounds like the gentleman who was speaking was thinking, oh, if you have a all in, state and local and Fed, let's say a 50% total, you could say, well, if the yield is that, essentially your tax equivalent yield is higher. That is not correct with what he said. Number one is, I imagine he's talking about treasury bonds or bills. Those are, and I'll ask you guys, right? What's the taxation on treasuries?
Are they federally tax-free? You still get taxed state, local?
They're subject to federal income tax.
Correct.
You're exempt from state and local. Yep. I just took my 65, Mike.
So you're charged federally. So basically, if you live in a state with state taxes, it's 1 minus the tax rate. So it's that divided by 1 minus the tax rate. And that gives you your tax equivalent yield. So no, you cannot buy 10% pre-tax treasuries right now. So that's a big podcast. And I'm sure, that was just a misspoken comment there. But I had somebody send it to me, and I'm like, no, you can't buy treasuries at a 10% pre-tax yield.
I wish. I was going to say, if you could do that, each year annually, like point me in that direction, please. Because I think that's the same that the market averages, right? And you're telling me I can do it tax-free? I would love it.
So you take, basically to do the tax equivalent yield, you take 1 minus the tax rate, and you look at the tax-free yield divided by 1 minus the tax rate, and that tells you your equivalent taxable. Okay. So that's probably what he was doing there. He's probably saying, well, let's round up to 5, and 5 divided by 0.5 is what? It's 5 divided by 0.5 is 10. So that's incorrect. So there you go. Don't believe everything you see or hear on the internet. I've listened to it every once in a while. I listen to it, or somebody passes it to me, and they're all in the they're on top of all the tech stuff and the AI stuff, and I was critical, not necessarily of Chamath. I was more critical of CNBC, because when he had his SPACs coming out, like, they literally gave him an infomercial. He would go on and talk about the company for like 20 minutes. And that's not his fault. Like, if they're going to give him the airtime, go for it.
Yeah, absolutely.
But, so hope that's your public service. And I'm surprised. Chamath must not have been listening, because he totally knows this. And so that's not, you cannot buy there's not a 10% tax equivalent rate on government bonds. All right. Did I do my public service announcement for the day?
You did.
Okay. Don't sue us, All In Podcast. Sorry. But anyway, it just, they caused me to have a long conversation explaining how this all works with somebody. So anyway. All right, let's go to recommendations, unless anybody has anything else. All right, Shane, recommendation.
All right, I'm going to give a pre-recommendation, because I was told by both of you to watch this show. My wife and I have been needing a new show to start. And so I've been wanting to watch Billions, but I think I'm going to wait. And we're going to watch, why am I blanking on the name, guys? Succession.
Yeah.
Yes. So I'm going to give a pre-recommendation on that. I'll try to get it started this weekend, and I will report back on what we think next week.
All right. Yeah, Succession's awesome. It's one of the best shows ever on TV. Mike, what was it, 4 seasons?
Is it 4? 4 or 5?
It's either 3 or 4. Yeah.
Oh, 3 or 4? Okay. It must be 4, I think.
It's probably 4, yeah. Like, I love that show.
It's for me, I think it's a top 5 show.
Oh, for sure. And, we don't want to ruin anything. You and I could talk separately, but like, there's the season finale of all those years were just awesome.
I'm so glad I don't have to sit and wait now. Like that's our favorite thing about starting a new show, is when it's like, we did that with Industry, and they've got one more season that's coming, and now we're all caught up, and we looked at each other at the end and we're like, oh my God, we got to wait 2 years now. Like, I don't know what I'm going to do over the next 2 years, Is it not coming back for 2 years? I think it comes back in 28 as the final season, I think.
Oh, well, sometimes what happens is, these shows, you have a cast, and maybe the cast isn't that big, and then all of a sudden they start to do movies, they start to do other stuff. I had read the show The Bear had that problem, where all those people were doing stuff, and the fact that they got them all for just one final season was kind of good. But going forward, I don't think they would have been able to get them all. So yeah. All right. No, that Succession, that's on my conviction list, Mike. It's a strong buy for me.
Oh, absolutely.
All right. What do you have, Mike?
I might be late to the show. I don't know. Maybe no one's ever heard of it. It's called Alone. I think there's already like 13 seasons, but it's a reality show about, I think there's like 10 contestants that are dropped off in various remote areas of the world. The season I'm watching, it's on Netflix. They get dropped off like in the Arctic Circle somewhere, and they all have camera equipment. They're by themselves, and the goal is to outlast and stay longer than anyone else. So it shows them hunting their food, building their shelter. It's very interesting so far. I'm like 3 episodes in. One woman hasn't eaten any protein in a week. She's just been eating these wild berries. One guy already, I don't want to give it away if you're going to watch it, but it's interesting to see the different survival tactics that they're all experienced. So they all know how to build a fire, and fish and hunt. So, right now it's a buy.
Okay. By the way, before we move on to my recommendation, if I have one, I know somebody will ask me, what about municipal bonds? So getting back to the thing we were just saying, the tax equivalent. Yeah, like muni bonds, they are exempt. Most of them are exempt in, if you buy, let's say you live in New York and you buy, New York's also city, triple tax free. But let's say you live in California and you buy a California municipal that's tax free. No state taxes on it, at least as of, we're recording now, and then no federal taxes. So yes, in cases there, but I think the muni yields right now, what are they, like 2.5%, depending on the state? At least, if you go, 30 years, maybe it's more like, 4.7, 4.5. I don't know. It depends on the state. So as I'm thinking, in fairness, because it wasn't really defined, maybe he's talking about municipal bonds, but those have more risk than U.S. government bonds. So is that fair? Like, to be fair to those guys, maybe they were thinking about munis.
Maybe. I think he said treasuries, but
he did say treasuries. Okay, all right. Well, I think
that's what I heard. But yeah,
I'll have to listen to it again. All right, since we don't edit the show, it will just be in there. All right, so I will give a book recommendation, and I actually forgot. I'm about halfway through this book, and I like it. It's called The Book of Elon, A Guide to Purpose and Success by Eric Jorgensen. I believe Eric Jorgensen is the same person who wrote the Almanac of Naval Ravikant. And what he did was he actually went through all of Elon's like public statements, and he's almost writing it in his own words. So he takes the public statement, and it's almost like a quasi-autobiography. It's pretty interesting how he got the idea to start building rockets. And and I may have mentioned this in the show before, but I saw it the other day, and I'm like, oh yeah, I read this on a bunch of planes, and I must have put it somewhere and forgot I never finished it. So I don't know what that tells you, but I think it's pretty good. So that and my Ulysses S. Grant book, I got to start reading. I got nothing else, though. Have you guys read that? Book of Elon?
No.
I have not.
Okay. Yeah, it's good. Kind of interesting. All right. We'll check the transcripts. We'll check the tapes. We'll see what we got right, what we got wrong. If you want to buy stocks, buy them. If not, don't buy them. But as we always like to say, we'd rather buy and hedge, because you never know what markets are going to do. And at least you aim to have some downside protection. So we'll be back next week. See you, everyone.